Please welcome all the way from San Mateo, California, Jonathan Curtis, Senior Vice President and Director of Portfolio Management, Franklin Equity Group. As Director of Portfolio Management, Jonathan oversees Franklin Equity Group's US-focused and sector strategy, portfolio management, and risk teams. And I think I've taken permission to say this, fingers crossed. Jonathan is the incoming Chief Investment Officer, Franklin Equity Group, effective January 1st. Welcome and congratulations.
Thank you. Thank you so much. Well, thank you. So I'm going to do a quick presentation here, and then I think we're going to sit down and have a conversation. Is that how we want to do it?
That's exactly what we're going to do, and I'm going to listen to your presentation from here, if that's okay.
Perfect. So I'm reminded sometimes life isn't fair. I do not know how I can follow that up, but I'm going to give it my all. I get to talk about a super interesting topic, both the U.S. equity markets and then a technology space and some of the other growth themes that we see in the U.S. markets. And I'm coming with an optimistic view. There's a huge debate going on right now about whether we're going to have a recession. If we are going to have a recession, how bad is it going to be? We are squarely in the optimistic camp, meaning that while we may see a bit of a downturn here, we are very much in the soft landing camp. And ultimately, we believe that outside of India, which is a fantastic place to be investing given all the opportunities that lie ahead, and hopefully we can talk about that, that in the developed world, the U.S. is probably a very good place for you to be thinking about diversifying into. The U.S. is loaded with a number of very high-quality growth businesses. It dominates the technology sector, which is one of the biggest contributors to the S&P 500. It's very important in healthcare, which is also a big part of the S&P 500, and of course, things like fintech, and it's leading in energy transformation. It's also a very profitable part of the world markets, and ultimately, the consumer there is in good shape, and if the consumer is in good shape, then we think enterprises will be in good shape, and we will get through this soft patch that we're in right now. So just a couple of things to zip through here. First, we'll start with, sorry, I don't want to stand in front of my slides here. The state of the employee in the U.S. right now. Very low levels of unemployment. Our thesis is if the U.S. consumer is employed, they're probably willing and capable of spending. Similarly, they have enjoyed wage gains over the past year and a half or so, in part due to inflation and their ability to go get leverage pricing power in this time of reopening, but ultimately, wage gains is allowing them to spend a little bit more, and so we think that is bullish. They also have relatively high net worth as a percentage of their personal income. So ultimately, they're feeling good about their own balance sheets and their ability to spend. Similarly, they have low debt levels as a percentage of their net worth. Now, when we think about the U.S. markets relative to other places that you can invest, the U.S. market is one of the most profitable parts of the world. We've got the big tech companies that are incredibly profitable, some of the healthcare companies that are very, very profitable, so it's a high-quality market. Also, very good high returns on equity relative to other places that you might want to invest around the world. And you can have your cake and eat it too. Now, I work in the Franklin Equity Group. We are a part of Franklin Templeton that is much more levered to growth and innovation investing. So we are biased towards that. But you can see here that when you look at the Russell 3000 growth, the companies that make that up, versus the Russell 3000 value, you can have your cake and eat it too. These companies on the growth side of the equation are highly profitable, generating very good free cash flow margins. So growth and profitability. You can see the same type of dynamic on returns on invested capital. Again, the growth businesses offer a very good equation for investors. Now, this shows 2023 revenue and earnings estimates across the various sectors of the S&P 500. Relatively low levels, definitely some areas of pressure. But if you look out to 2024, this is consensus views right now on growth across the various sectors of the S&P 500. But again, a more optimistic view, a more positive view about what's going to happen fundamentally in the U.S. equity market. This shows valuation on the S&P 500 on a price to forward earnings basis. Now, you can see that the PE multiple is a little elevated right now. That's dominated primarily by the valuation increases that we have seen for the so-called Magnificent Seven. Firms like NVIDIA, Apple, Tesla have all done quite well this year. We do not think that the multiple is excessively high when you consider what is coming for some of these companies and more broadly in the markets. And I mean specifically the growth opportunities that are going to come with artificial intelligence and generative AI specifically. We learned here over the past 2 quarters that investors were dramatically underestimating the growth potential for firms like NVIDIA. The E in their PE was way too low. Investors did not appreciate what lies ahead, what lay ahead for that company. We think the same type of thing lies ahead for firms like Microsoft, like Meta, like Tesla, all very levered to the big opportunity around generative AI and artificial intelligence more broadly. So while this PE multiple looks high, it is missing the revenue contributions from artificial intelligence, and then more broadly, as companies start employing this technology into their businesses to become more productive, we're missing also the margin support that will have. Now, certainly, the Magnificent Seven have become very big parts of the U.S. equity market. The orange line or the red line shows the percentage of the Russell 3000 growth that is coming from the Magnificent Seven. Dominant, very, very big. Even in the S&P 500, the Magnificent Seven represent almost 28% of the S&P 500. So very, very big contributors and huge contributors to the gains in the S&P 500 during the past year or year to date. But you can go down market and find good value. I'm going to show you a handful of names or many names that we have represented in the strategy that we sell here in India in partnership with many of you, our U.S. opportunity strategy. I'm going to show you names that are not Microsoft and NVIDIA that are going to benefit from these opportunities in artificial intelligence or healthcare or energy transformation. And in aggregate, some of these smaller and mid-cap names that we own are trading at really attractive valuations. 14 times forward earnings for businesses that are going to not only get revenue out of these growth opportunities that we're going to talk about, but also productivity gains. So you don't have to buy the main indices in the U.S. You can go down market cap and buy stuff where things look fundamentally cheap, we believe. We'll skip over this. So let's talk a little bit about some of the big themes that we're excited about that are well represented in the strategy that we sell here in India, our U.S. opportunity strategy. The first big theme that we're excited about is digital transformation. Our thesis is that companies, governments, industries are still in the early days of learning how to use software and data to better understand their customers and their business processes, and then technology to radically transform how their industries operate. Now, underneath this big opportunity of digital transformation, we've identified 10 key supporting sub-themes. This includes artificial intelligence, fintech and digital payments, cloud computing, software as a service, Internet of Things, all well represented in digital transformation. But let's talk about the sizes of some of these opportunities. Now, this is a chart that you would expect a person like me to show, and up and to the right type of chart shows how many trillions of dollars are expected to come from digital transformation in the years ahead. We'll go out to 2026. This firm Statista is estimating that there's going to be $3.4 trillion spent on digital transformation. We think this profoundly underestimates actually what is going on. We'll just talk about 2 of the themes that are critical in digital transformation: cloud computing and artificial intelligence. We estimate that cloud computing alone is a $2 to $3 trillion opportunity that is still somewhere between 10 and 20% penetrated. And that is for the legacy workloads, the workloads that used to run in on-premise data centers that still have to be moved over to the public cloud. That gives no credit for the new workloads that are going to come in, specifically things like generative AI. But let's talk about the artificial intelligence opportunity, a component of digital transformation that we also do not think is represented in estimates like this. McKinsey estimates that artificial intelligence, and specifically generative AI, is going to add somewhere between $2.5 and $4 trillion of value to the global GDP in the next few years. That's nowhere represented in this number. So we think there is an enormous opportunity in just those two pillars of digital transformation. And the strategy that we sell here in India, our US opportunity strategy, has roughly 50% of the fund allocated to tech and comm services. So essentially that area of the market that we would call overall technology. So very well represented in the strategy. And these are some of the firms that are both selling digital transformation technologies and benefiting from the usage of them. Let's just focus on two of them. We'll start with ServiceNow, and it'll give you some insight into our process and how we find ideas. We've had ServiceNow in many of the strategies in the Franklin Equity Group, including this one, the U.S. Opportunity Strategy, ever since the company IPO'd. At the time of the IPO price was about $3.5 billion. This company was doing less than $250 million of revenue. It was growing at a very good clip. It had very high retention metrics, very strong management team that we had seen execute before, and good unit economics. So it foretold a highly profitable business at maturity. But the one thing it didn't have was positive free cash flow. It was burning cash at the time of the IPO. But we bought it because we saw all those quality signals, and we understood, despite all the controversy around the name, that this company had a much larger opportunity than investors were giving it credit for. So we bought it at the IPO. We've continued to hold it. It's been a tremendous alpha generator in our portfolios. So now let's talk about where it is today. It's at $7 billion of revenue. It's over $100 billion of market cap. It still has all those same metrics around high retention, good unit economics, very strong management. But now it also is generating a lot of cash, 30% free cash flow margins. And we think it is well on its way to getting to $11 billion in the next few years and $15 billion of revenue in the years ahead. So a long growth trajectory ahead. This is the type of business that we look to find it before our peers, look through the controversy, see the long term, and then own it in size so it benefits your clients. Let's talk about one of the users of digital transformation, a business that is using these techniques, artificial intelligence, cloud computing, digital media transformation, direct customer engagement technologies, and it's Nike. Nike has been a fantastic shoe manufacturer for many years, but it went through distribution partners for most of it, the history of the company. But now they are in the process of building direct relationships with their end customers, seeking to understand them better, directly selling to them, getting data about their customers, and ultimately using that data to get better pricing, better segment their market, and ultimately serve the needs of their customers and become more efficient. And it's run by one of the former management team members from ServiceNow. And the gentleman used to also be the CEO of eBay. So he deeply understands the value of technology in businesses, and he deeply understands the value of digital transformation. So we are able to find the suppliers of the technology and the users of the technology and generate alpha for you in our strategies. Let's spend a little bit of time talking about the details behind artificial intelligence. So I've been in the technology space for more than 30 years now, and I have not been this excited about something for a very long time. It takes me back to that moment in 1995 when I saw the first web browser, and I wish I had understood then what was coming ahead. I wish I had seen way in advance to what Amazon was going to be able to build or what Facebook was going to be able to build. We think something similar is starting with generative AI. So artificial intelligence has been around for many, many years now. It's been in the back ends of major internet platforms like TikTok. Facebook has used it successfully. Google has used it successfully. Many in the financial services industry have used it to manage risk and build portfolios. Certainly it's even been used in the healthcare industry to analyze x-rays and other images. But up until about a year ago, it has not been in the hands of end users. With generative AI, these technologies that allow people like you and me to interact with these large language models or these models that allow you to create content, we are effectively able to program computers with the English language, with the languages that are spoken here in India, and get them to do interesting things. Generate ideas for you, help you be more creative, suggest questions you should be asking management teams when they come visit, generate a limerick, help you summarize your email inbox, allow you to join a meeting, a digital meeting late, and ask the meeting while it's going on, what have you missed in the meeting, right? When these technologies are deployed in the tools that knowledge workers, hundreds of millions of knowledge workers, software developers, customer service agents use every single day, we think they're going to unlock a profound amount of productivity. So let's just look at this through the lens of one discipline that's going to use it. Microsoft is a big player in software development tools, and they have been investing massively in the opportunity around generative AI. Now, they're going to put these tools in every single one of their products, but the first area that they're putting them into and where they're directly monetizing right now is their software development tools. We estimate there are 30 to 40 million software development engineers around the world. I had a chance to meet with Satya Nadella, the CEO of Microsoft, 3 or 4 months ago, and I asked him, I said, Satya, you've been CEO for many years now. What are you most proud of about your time at Microsoft? And he said, I'm most proud of what we have done with these generative AI models in the tools for software developers. For the software developers that have been using these models in the software development process, these developers are able to generate 40 to 60% of the code they are writing directly out of these models. So as they're using they're doing the software development process, their tools are coming back and say, it looks like you're working on a sort algorithm, or you're building a user interface. I recommend you do this, use this code. Or you just wrote some code and there's a bug in it. I recommend you do this to fix it. Or would you like me to comment the code for you automatically? That's happening. These things are working, and the developers who are using them are being able to be a lot more productive. Now, the more interesting thing happens for a Microsoft when these very same large language models that have been trained on all of the text on the internet, and eventually will be trained on all of the private content inside of our firm, your firms, come along and are deployed inside of the Office Productivity Suite. They will do something similar. You will be sitting and typing an email, and the Outlook will say to you, would you like me to recommend a response to this email? Or I get 300, 400 emails a day. I'll be able to say to Outlook, I can't read 400 emails today. Would you please summarize the most important emails that I need to be reading, and please rewrite them in a simple format so I can consume them quickly? Or please take this thread of content and summarize it for me quickly so I can respond. And please propose a response, right? Or please create the first version of marketing copy for a new marketing campaign that I need to do. Or please generate the slides for a presentation I need to do in India. These are all things that are working now and will be available for sale from Microsoft in not years from now, but in months from now. But let's think about the revenue impact from Microsoft, and that will help you understand why we are so excited about what lies ahead in this opportunity. There are 500 million commercial Office users around the world. Microsoft has announced pricing for these generative AI features in Office. They're going to try and get $360 per user per month for these capabilities. 360 times 500 million is $180 billion of potential incremental revenue for Microsoft. Microsoft, across its entire business, 4 big pillars of its business, did $180 billion of revenue in total in 2018 or 2019. They could nearly double the company on the sale of these generative AI features, and that's in just one product category. And yet they're putting these generative AI features in their cloud products, in their Windows products, and in their gaming products as well, not to mention also their software development products. So there's an enormous opportunity for Microsoft. So let's go back to this PE multiple here. I am confident that in the PE multiple, just like for NVIDIA, investors do not appreciate the earnings potential that's going to come for a firm like Microsoft. And Microsoft, of course, is one of the biggest contributors to the S&P 500 in terms of percentage gain. So I think in the next 18 months to 2 years, we're going to start seeing their earnings inflect in a meaningful way. But we don't just own Microsoft and NVIDIA in our strategies. We also own and have identified opportunities well outside of these companies who are either going to sell the enabling technology or going to embed generative AI capabilities into their products. Now, thus far, if you're following the technology market, you have seen NVIDIA generate tremendous amount of revenue out of nowhere here in the past 2 months, 2 quarters on this opportunity. And some of the companies right around NVIDIA in both the foundry space, firms like Monolithic Power, the companies that sell the power supplies that go alongside of the NVIDIA GPUs. But we're going to start seeing other companies on this chart here start showing also revenue pull-through. The one challenge that the markets, I think, are going to have right now, and they've done very well on this speculating and looking ahead for this generative AI feature, is we are in the build and experimentation phase for generative AI. We've seen the positive impacts for NVIDIA, and we think they're going to go on for a while. But we now have to transition from the build and experimentation phase to the application phase, to the phase when Microsoft is able to start monetizing, or some of these other companies are going to start monetizing. And I think there is a bit of a risk in markets as we wait for that handoff to occur. We've already seen that a bit with some of the big technology names here who have recently reported. Investors have been a little disappointed that they haven't seen the follow-through for an Oracle yet, or for even a Microsoft yet on this opportunity. What I believe and what I'm confident of is that this opportunity is coming. It's going to be profound, and ultimately investors should be taking advantage of this next couple of quarters of concern that we're going to see in the markets and buying, because we're going to go on a curve that it perhaps will be every bit as big as what we saw with the internet itself. And of course, these are some of the areas outside of tech that are going to use generative AI and artificial intelligence. Healthcare, big opportunities there. The industrial sector, Uber's already making big use of it. The consumer sector for doing marketing campaigns and customer segmentation, going to see real benefits. And of course, the financial services sector. Now, it's not just AI that we have represented in the U.S. opportunity strategy. About 13% of the strategy is invested in the healthcare opportunity. A very big growth opportunity lies ahead there as the population in the United States ages, as chronic diseases continue. I'll just zero in on one part of the opportunity, the obesity epidemic in the United States. We estimate about 1/3 of Americans are obese. It's a major problem in the United States. It causes issues and costs all throughout our healthcare system with diabetes, heart issues, etc. Some of these drugs that are starting to come out from the likes of Eli Lilly and Novo Nordisk, we think are going to have tremendous growth ahead. We estimate the market for these drugs could be eventually $100 billion in size. And we think that almost half of that revenue could end up with the likes of an Eli Lilly. We do not think that that is fully represented in their stock price. And ultimately, it's a name that we own in the portfolio in size. So a lot of big opportunities in the healthcare space. In the financial services space, fintech, about 7% of our strategy, very critical. India has gone on an amazing journey, as has China, getting to a cashless society. Still, a lot of work remains in India to get fully to a cashless world, but also outside of India and China. And so we own very high quality businesses like Visa and MasterCard that are enabling that in the consumer space, or Bill.com in the small, medium business space that is helping to automate payments. So big opportunity there. And then finally, the final main theme I want you to be thinking about represented in this strategy is energy transformation. Certainly you've heard of names like Tesla. Maybe you haven't heard of a firm like NextEra Energy. They're a very innovative utility located in the United States. They operate a proper utility and a very innovative utility in Florida, but they also sell renewable sources of energy, or renewable energies, around the country in very innovative ways to other utilities. Let's just talk about the opportunity with Tesla. So they're not only a leader in the EV market, and that will help deal with the challenges that we have with climate change, but they're also a powerful player in artificial intelligence. For years now, they have been collecting data out of their fleet of cars and learning how to drive on streets. And they're not using wildly advanced sensors, they're using eyeballs, right? They're using cameras, much like we do. We have eyes on our head for figuring out what's going on and how to navigate things. They're getting very close to the point where they're going to be able to start recognizing the revenue from their full self-driving software. And we think that people are going to buy it. Why would they buy it? Because ultimately, we think that the full self-driving software will allow driving to be dramatically safer, and it will also free up time for people to do other things in their cars than focus on driving. Now, what are the economic impacts of this? Tesla sells a vehicle for about $50,000. They get about 30% gross margins on that, so I don't know, maybe that's $15,000 of gross profit for the company. Let's talk about what they could get for a driver who adopts full self-driving. They're trying to charge $200 per car per month. You assume that they can get $2,400 per year per car and that the car lasts for 10 years. That's $24,000 of gross profit. Dramatically more than the gross profit they could get on the vehicle. So what does Tesla have a huge advantage to, or an incentive to do? To drive up the fleet of Teslas massively just before that point when they have full self-driving working. So a lot of underappreciated earnings power is buried in a firm like Tesla. Just a little bit about our group. I come from a group called the Franklin Equity Group. We are headquartered in Silicon Valley. About 2/3 of our team operate out of Silicon Valley. Another third of our team operate out of New York. But you will see we're a very well-resourced team. Many investment professionals across each one of the teams. The team I lead within the Franklin Equity Group is the technology and communications team. When we put ideas in the portfolio, we evaluate them always first through the lens of quality. We want to own very strong businesses led by strong managers, companies with strong financials and or strong unit economics that foretell good profitability in the future. We want to own businesses that have very big growth opportunities. And I just spoke about a handful of them that I don't think are fully appreciated by investors right now. Businesses that have a very long runway for growth. We think investors tend to overestimate near-term growth and underestimate the durability of growth. So we take advantage of our long-term perspective and really own names for the long run. And then, of course, valuation-wise, we are growth investors, so we are not valuing these businesses off their next 12-month earnings or their next 12-month revenue. We are trying to look out into maturity and understand what we are underwriting, what these businesses could be worth when we account for the full revenue potential that lies ahead, when we account for them reaching their full margin structure, and then we discount that back to the present. So a very disciplined process around valuation. We also use ESG analysis to understand the quality of these businesses and really to help us deeply understand the risks that we're facing. So we're looking at the environmental costs that these companies are imposing on the world, the societal costs, and ultimately whether these companies are well governed. And then finally, we use disciplined risk management to ensure that we are meeting the objectives that we have laid out for our clients and ultimately constructing the portfolios in a way that will deliver the returns that we need. So I'll stop there. I'm happy to chat with you and take any questions that you have.
Jonathan, I'm not being fawning here. I'm being honest when I say the examples that you shared of underappreciated developments that are taking place in the technology space, I think those examples really hit home, whether it was Microsoft or Tesla, and what is not obvious at the particular moment. Now, you've covered so much ground that I'm going to make my questions a short list.
Okay.
And I'm going to stick to the bits that perhaps the Indian audience is also interested in beyond what you've already described. But first, the personal. First visit to India?
First visit to India.
Liking it so far?
Amazing.
Like the food?
The food, Yes, absolutely, of course.
I mean, we don't give anyone a chance. We just say, do you like it? Do you like the food? And you just have to say yes. But honestly, I get the sense that you've had the exposure to Indian food long before your visit here.
I live in Silicon Valley, so I am well versed in Indian culture and Indian food.
Okay. You talked about, U.S. equities, U.S. Economy, and I won't get into details of that, but I have a tendency to ask about the negatives.
Sure.
So what risks do you see to U.S. equities right now? And if you could break them up into negative risk, positive risk, that would be great.
Well, certainly, we'll start with where I spend a lot of time. I am super excited about artificial intelligence and generative AI, and I use these tools now in my own work almost every day. But maybe I'm wrong, right? Maybe enterprises don't want to buy these tools. Maybe they don't want to make, maybe the productivity gains that I anticipate coming out of them aren't going to be there. Now, we have done some work on this. We're going to be joining Microsoft's trial on these tools. The demand to get into the trial is very high. They're charging us money to participate in the trial. So my sense is that it's a strong signal that there's very high interest in using these tools. But that could be one area where we could be wrong. And the Magnificent Seven that have done so well here year to date have done well largely on this opportunity around artificial intelligence. The next area of concern certainly is interest rates. And so, I was paying close attention to the CPI print that came out late last night, and I was encouraged to see that the core number was up only 0.3% month over month. The headline number was a little higher, and that's being driven by rising oil prices and the like. But if the Fed is finding it's not able to get its arms around inflation, they will keep raising rates, and that will be a negative for duration assets, growth assets, the types of businesses that we invest in. So that makes me concerned and something we're watching closely. I think those are the two
Political
major
risk?
ones. Yeah. So it looks like we're either going to have a Biden presidency or a Trump presidency. If we get a Trump presidency, I think we will have largely many of the same policies with two exceptions. One, he may be a little less willing to have the U.S. involved with NATO, and that creates risks around what's going on in Russia, Ukraine, and creates risk for our European friends. And then secondly, I think he will be more inclined to lean into protectionism. And that's just not great for global trade and capital markets.
Okay, you've, I think, made the point very clearly early on in your presentation that you're in the soft landing camp, so I'm not going to spend any time repeating that. But just beyond the US, a global economic growth slowdown, if that plays out?
Yeah, I'll make the case for the U.S. being the best place out there. Europe is still absolutely dealing with inflation. They dodged a bullet last year with a mild winter, but that's no guarantee that we're going to see that again, and their demand seems to be slowing pretty meaningfully over there. And that also is a risk for the U.S. Certainly these large technology companies get about 30 to 40% of their revenue from Europe, so Europe is an area of concern globally. And then China. China is struggling with issues in its property sector, deflation, and Xi is signaling that he's not coming to the rescue, and he's super hard to predict. And I think, quite frankly, all of that last little bit of it bodes well for India. I think that India, the world is eager to have another partner in Asia that can grow and that shares our same values, and hopefully India can be that.
Well, we've spent a lot of time talking about China plus one, and the advantages that could accrue for India. But give me a sort of insight into how a company like Apple, for example, gets specifically affected. And a follow-on question to that is, semiconductors, chip fabrication specifically, is the India opportunity real? Can India really really, truly, and honestly capitalize on it?
Yeah, I'm a little more skeptical on the opportunity around semiconductors, the fabrication of them, perhaps some of the packaging of semiconductors, the lower value things. It's going to take some time to replicate the skills that you would find at a TSMC in places like the US. We're going to struggle to do that. So I think that India would really struggle with it. But that does not mean there's not a tremendous manufacturing opportunity for India with Apple. Currently, we estimate about 3 to 4% of Apple's iPhones are made in India right now. We think that can get to as high as 25% in the years ahead. And if you take out the iPhones that are built in China for China, India could be as much as a third of iPhone production. So I think that that is a fantastic opportunity for India. And with the manufacturing of very precise miniature electronics like that, I think India will build a lot of skills, and then they'll be able to use that and continue up the ladder of value creation and into new areas of manufacturing. What I'm really excited about for India is their ability to take the fantastic work they've done in software and IT services and start building their own IP and their own great companies.
So you've led me right to my next question, which is, if there's one preoccupation that we have sitting in India saying, are Indian software service companies, how would you like to see them evolve, capitalize on the opportunities and disruptions happening in the spaces they operate to really ensure, a fresh valuation bounce?
Yeah, well, so certainly the IT services firms need to move up from sort of low-value business process outsourcing, low-value basic software development, up into architecture work and advising of firms. And some of your big IT services firms are doing that. But I'm also excited about just venture capitalists coming into the country and investing in entrepreneurs and good ideas and having great companies built here that control their own IP. We've already seen this with firms like Freshworks. Zoho has been a great Indian success story, and there should be many, many more of them. And so I think that's what lies ahead for the company or the country over the next many years.
Okay. Final thoughts for partners who've gathered here today. I think that, and I'm literally repeating what I said at the start of this conversation, I have got a much more real, tangible sense of how AI is playing out and what the future could look like. But final thoughts for partners in the room today.
Listen, I would say to your clients that investing in India makes a lot of sense. But I also think it's important that your clients are diversified and that they have exposure outside of the country and into some of the highest quality markets out there. And I think the highest quality equity market to be involved with is the US, because it's highly profitable, because it's got leverage to the best growth themes, and it ultimately is going to be a great partner to firms in this part of the world. So.
The center of innovation as well. I mean, there's no challenger in sight as far as innovation in the United States goes. Jonathan Curtis, thank you so much.
Thank you so much.
Absolute pleasure talking and listening to you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.